The next section for discussion is section 194M. This was inserted by Finance Act 2019 with effect from 1st September 2019. Here the payment is a sum for carrying out work to a resident, or it is fee for professional services, or it is commission not being one covered by 194D, or brokerage, and the payee is a resident, payer is an individual or HUF who has no obligation to deduct tax at source under 194C or 194J or 194H. So such payer, when he is making payment for carrying out work, or when he is paying fee for professional services, or when he is paying commission not being one covered by 194D or brokerage to a resident, and the aggregate amount of such payments to such resident payee during the financial year crosses 50 lakhs, then the individual or HUF has TDS obligation when at the time of payment or the time of credit to the account of the payee in the books of accounts of the payer, whichever is earlier, tax shall be deducted at source at the rate of 5%. And for deducting tax at source, this payer need not have TAN, it is enough if he is having PAN. Fine. To consolidate, where an individual or HUF who is not having any obligation to deduct tax at source under 194C or 194J or 194H makes payment for carrying out work or pays fee for professional services or a commission not being one referred to in 194D or brokerage to a resident payee, and the aggregate amount of such payments during the year is crossing 50 lakhs, then such individual or HUF has TDS obligation under 194M. Tax shall be deducted at source at the time of payment or the time of credit to the account of the payee in the books of accounts of the payer, whichever is earlier. And tax shall be deducted at source at the rate of 5%, subject to 206 AA, and the payer for deducting tax at source under this section need not have TAN. It is enough if he is having PAN. That you need to note. So to visualize, see these examples. Mr. G is an individual. He is paying rupees 60 lakhs to a catering organization. The catering services are availed by Mr. G from this catering organization in connection with marriage of his daughter. Now in this case, now listen to me. Mr. G is availing catering services in 194C. The work definition, if you see, it includes catering. So catering work is done by the catering organization. For that payment is made. This is crossing threshold limit, but still Mr. G has no TDS obligation. Reason being, the payment is made exclusively for personal purpose. The payment is made exclusively for personal purpose. So when the payment is made exclusively for personal purpose, 194C will not come But in this case, Mr. G, individual, is making payment to a resident for carrying out work and the amount is crossing 50 lakhs. So there is a TDS obligation under 194M at the rate of 5%. Now, let us assume this way, Mr. G is tax auditee, then also there is no TDS obligation. If he is not a tax auditee, then also there is a TDS obligation under 194M. Because 194M doesn't say the payer being individual or HF should have been liable to tax audit in the immediately preceding financial year. The TDS obligation under 194M arises whether Mr. G is a tax auditee or not in the immediately preceding financial year. Then I will give you another example. Mr. G, is not a businessman, is a salaried employee and is paying a commission of 60 lakhs to Mr. K, a broker who facilitated purchase of a palace for Mr. G. In this case, what happens? Commission is paid. The commission is not insurance commission, and this is crossing the threshold of 15,000 rupees. But still, Mr. G has no TDS obligation under 194H because he is not a businessman, he is not a tax auditee. Therefore, there is no TDS obligation for Mr. G under 194H. But still, since Mr. G is an individual, the payment is commission not being one covered by 194D and payee is a resident, payment is crossing rupees 50 lakhs, Mr. G is having TDS obligation under 194M. So thus 194M was inserted even to capture those situations which doesn't warrant deduction of tax at source under 194C, J or H. So in these circumstances, 194M can be pressed into operation provided the payment is a heavy payment, it is crossing 50 lakhs. That way you need to understand. So with this, we are through with section 194M. Next section is 194N, where a person is having one or more accounts with bank or cooperative bank or post office and is withdrawing cash from such accounts maintained with bank or cooperative bank or post office, and the aggregate withdrawal in cash from these one or more accounts maintained with bank or cooperative bank or post office crosses rupees 1 crore, then in that case, the bank or cooperative bank or post office has TDS obligation under 194M. This section is inserted by Finance Act 2019 with effect from 1st September 2019. So the bank or cooperative bank or post office has TDS obligation under which section? Under section 194N. At what rate tax shall be deducted at source? Tax shall be deducted at source at the rate of 2%. This 2% should be applied on what? The aggregate of cash withdrawals minus 1 crore. That means on withdrawal exceeding rupees 1 crore, there will be TDS at the rate of 2%. And when tax shall be deducted at source, the tax shall be deducted at source at the time of withdrawal, at the time of payment. Now, generally, when we are deducting tax at source, out of your income, even that TDS is also your income. Okay, we include it in your income sheet and the TDS is taken as a credit against the tax payable. But since here we are withholding tax at source out of the cash withdrawal, the TDS in this case will not be regarded as income of the account holder, but for which credit alone is available under 199. Credit alone is available. Suppose if rupees 2 lakhs is the professional fees paid to you, out of that 20,000, 10% be withheld by way of TDS. But in your income sheet, okay, while computing your taxable income, the fee for professional services is not taken as 1 lakh 80, it is taken as 2 lakhs including the TDS. The TDS is also deemed to be income received by you, correct? But for this, you will be getting a credit against the tax payable. But that is not the case here because we are not withholding TDS out of income. So therefore, this will not be added to the income sheet of the account holder, but for which credit alone is available under 199. So to consolidate, where an account holder withdraws cash from one or more accounts maintained by him with a bank or cooperative bank or post office, and the aggregate amount of withdrawal in cash is crossing rupees 1 crore, then the bank or cooperative bank or post office has TDS obligation under 194N on the cash withdrawals exceeding rupees 1 crore. Tax should be deducted at source at the rate of 2%. Tax shall be deducted at source at the time of payment. So, Finance Act 2019 has inserted this section with effect from 1st September 2019. Okay, see, we have some illustrations in this regard. Further, we have exemptions in 194M also. When cash payment is made to government, or it is made to bank, or it is made to a cooperative society engaged in business of banking, or post office, or any business correspondent of a banking company, or a cooperative bank in accordance with the guidelines issued in this regard by RBI, or any white label ATM operator of a banking company or a cooperative bank, or such other person notified by the central government in consultation with RBI, 194M shall not apply. That means where the withdrawal is done by these persons in cash, 194N, wrongly typed as M, 194N shall not be precedent to operation, Now we are entering into section 195. The next section in pipeline is section 195. TDS on payment to foreign companies or non-corporate non-resident. Foreign company or non-corporate non-resident. Here, what is the payment? Payment is any sum chargeable to tax under this act, which is not covered by any other sections in chapter 17B. The payee should be a foreign company or a non-corporate non-resident. Payer may be anybody. Okay, then the payer has TDS obligation. At what rates tax shall be deducted at source? At rates in force. You all know what is rates in force. Rates in force is the rates given in Finance Act first schedule, part 2, or double tax avoidance agreement rates, whichever is beneficial, when tax shall be deducted at source at the time of payment or at the time of credit to the account of the payee in the books of accounts of the payer, whichever is earlier, at that time tax shall be deducted at source. So what is the payment? Payment may be any sum chargeable to tax under this act, but not being one covered by section chapter 17B. I'll give you example. To a non-resident, if you are paying salary, the TDS will be made under 192, not under 195, because it is specifically covered there. If you are making payment to a non-resident who is a foreign citizen, who is a sportsman or athlete or entertainer, and the payment is for participation in any games in sports played in India, or for contribution of articles relating thereto, or for advertising, then the relevant TDS section is 194E. It is specifically covered there. Or where lottery winnings are payable to a non-resident, it is specifically covered in 194B. So in those cases 195 shall not apply. That's why we are telling payment covered by 195 is any sum chargeable to tax under this act which is not covered by other sections of chapter 17B, and the payee should be a foreign company or a non-corporate non-resident. Then the payer may be resident, payer may be non-resident, that's not an issue. The payer has TDS obligation under section 195. The tax shall be deducted at source at what rates? Rates in force. Rates in force is defined in 237A, which directs us to go to Finance Act, first schedule part 2. Compare that with the DTAA rates, whichever is beneficial shall be the TDS rate. When tax shall be deducted at source, the time of payment or the time of credit to the account of the payee in the books of accounts of the payer, whichever is earlier. Fine. The payer may have a place of residence in India or may not. May have place of business in India or not. May have business connection in India or not. That is not relevant. Even if he is a non-resident who doesn't have any place of residence in India, who doesn't have place of business in India, who doesn't have business connection in India, still he is having TDS obligation. TDS obligation. Then the payer may be individual or HUF, liable to tax audit or not in the immediately preceding financial year. That is not at all relevant. Still there is TDS obligation. Still there is TDS obligation. Next is, I was telling you the payment is any sum chargeable to tax under this act. Any sum chargeable to tax under this act. This chargeability of income shall be decided keeping in mind the provisions of Income Tax Act as well as double tax avoidance agreement. The chargeability shall not be decided just keeping in mind only the provisions of Income Tax Act. DTAA provision should also be considered. The DTAA supersedes the provisions of Income Tax Act. Even if it is chargeable as per the domestic law, if it is not taxable as per the DTAA, the question of deducting tax at source under 195 doesn't arise. Next is, where the payment is interest and it is paid to a foreign company or a non-corporate non-resident, and the payer is government or a public sector bank or a public financial institution, then tax shall be deducted at source only at the time of payment. So where the payer is government or a public sector bank or a public financial institution and the payment is interest and the payee is a foreign company or a non-corporate non-resident, the TDS obligation arises only at the time of making payment. Only at the time of making payment. Fine. That you need to understand. Next is section 195, subsection 3, and subsection 4, where the payee, foreign company or non-corporate non-resident, makes an application to the AO under 195 subsection 3 seeking non-deduction certificate, and the assessing officer is satisfied that there is no need for deduction of tax at source, he may issue non-deduction certificate. Then that non-deduction certificate, if it is produced to the payer, then the payer has no obligation to deduct tax at source while the certificate is in force. Next is 195 subsection 2, where a composite payment is made to a foreign company or a non-corporate non-resident, which is not pure income payment like interest or salary, which is a composite payment like payment made to the contractors or subcontractors. It's a composite payment made to the foreign company or non-corporate non-resident in which the income element is hidden or embedded. Entire amount is not representing income. Okay, income element is hidden or embedded in this composite payment, and the payer is not in a position to know exactly what is the income element hidden or embedded. Then the payer may seek the support of the AO. He can make an application to the assessing officer requiring him to determine what is the income element hidden or embedded in that composite amount. Hidden or embedded in the composite amount, correct? Can make application to the AO seeking determination of income element hidden or embedded. Then the AO, okay, shall pass an order determining the income element, then the payer out of that composite amount, okay, he can take only the income element hidden or embedded. On that alone he will apply the TDS rate and deduct tax at source, correct? This is section 195 subsection 2. Then the payer has to furnish information relating to payment of sum to the foreign company or non-corporate non-resident to the department. Whether the sum is chargeable to tax or not under this act, the payer is having an obligation to furnish, okay, information relating to payment of sum to the foreign company or non-corporate non-resident in form 15 CA, CB, CC, etc. Next is TDS violation consequences. TDS violation consequences. But when I say TDS violation, I am not talking about, okay, all the TDS violations. We are only talking about 4 TDS violations: short deduction, non-deduction, non-remittance, okay, non-discharge of obligation assumed under 192 1A. What is short deduction? You are supposed to deduct tax at source and warehousing charges under 194I at the rate of 10%. But to the contrary, you have deducted tax at source under 194C at the rate of 2%. So there is a short deduction of 8%. So this is one case, short deduction violation. Or you don't deduct tax at source only. You have not deducted tax at source only. Or you have deducted tax at source but you have not remitted it to the credit of the government. There is a non-remittance. Or the employer under 192 1A assumes the obligation to pay the tax on non-monetary perquisites enjoyed by the employee, but is not keeping up his promise. He is not discharging this obligation. Then the employer becomes, okay, guilty of TDS violation. So what are the TDS violations? We are talking about short deduction, okay, non-deduction, non-remittance, non-discharge of obligations assumed by the employer under 192 1A. In these circumstances, the deductor or employer becomes assessee in default. So department can brand the deductor or the employer as assessee in default through an order under 201 subsection 1. Through an order under 201 subsection 1. Fine. However, there is a proviso 1 to 201 subsection 1. What it says? Here there is an amendment brought out by Finance Act 2019. Be careful. Where any payment is made without deducting tax at source, not only for resident here, even to a non-resident. Where payment is made without TDS to a non-resident or a resident, okay, then also the payer shall not be regarded as assessee in default, is guilty of non-deduction. but still he shall not be regarded as assessee in default. He shall not be regarded as assessee in default. If the following conditions are fulfilled, what condition? For the relevant assessment year, the payee has filed return under 139. Payee has filed return under 139 for the assessment year relevant to the previous year, to which he has received to which the sum received without TDS pertains. To which the sum received without TDS pertains. He filed the return. While computing the returned income, he has included the sum received without TDS. He has considered the sum received without TDS in quantifying his returned income. Then the tax due on returned income was promptly paid by the payee by way of advance tax or self-assessment tax. By way of what? Advance tax or self-assessment tax. To consolidate, where a payment is made without TDS, maybe to a resident or non-resident, though the payer is guilty of non-deduction, he cannot be regarded as assessee in default, provided the payee complies with these conditions. What condition? The payee files return under 139 for the assessment year relevant to the previous year to which the sum received without TDS pertains, and while computing the returned income, the payee has considered even the sum received without TDS. Then the tax on the returned income was completely paid by the payee by way of advance tax or self-assessment tax, and the payer obtains a certificate in form number 26A from his auditor to this effect. Then the payer cannot be regarded as assessee in default. Cannot be regarded as assessee in default. Next is, now under 200 subsection 1, we pass an order declaring the deductor or employer as assessee in default. Assessee in default. So within what time this 200 subsection 1 order shall be passed? Where tax was deducted at source, but the deducted tax is not remitted to the credit of government. Is not remitted to the credit of government. There is non-remittance. For that, the 200 subsection 1 order can be passed declaring the deductor as assessee in default anytime, absolutely no problem. Next is, where the employer has assumed the obligation to pay the tax on non-monetary perquisites under 192 1A, but is not discharging this obligation, then the employer can be regarded as assessee in default. For that purpose, order can be passed under 201 1 anytime, no time limit. Where there is short deduction or non-deduction and the payee is a non-resident, that is, payment is made to the non-resident without TDS or after TDS, but the TDS is not is falling short of requirement. Then if the payee is a non-resident, the payer can be regarded as assessee in default anytime through 201 1 order, no time limit. But where there is short deduction or non-deduction, the payee is a resident. And there is short deduction or non-deduction. So payment is made to a resident without TDS, or the TDS is made but it is falling short of requirement. Then the payer can be regarded as assessee in default through 201 1 order. Within what time? Here Finance Act 2019 amendment is there. What it says? The time limit is 7 years from the end of the financial year in which the payment or credit is given, on which we need to deduct tax at source, or 2 years from the end of the financial year in which the correction statement is filed, whichever is later. So what is the time limit for passing 201 1 order declaring the payer as assessee in default, where there is short deduction or non-deduction in respect of payment made to a resident. The time limit is 7 years from the end of the financial year in which the payment is or credit is made on which tax ought to have been deducted at source, or 2 years from the end of the financial year in which the correction statement was filed. Fine. So just now what we have discussed is the time limit for passing order under 201(1) declaring the deductor or employer as assessee in default. Sorry. What are the TDS violation consequences? We have started discussing the consequences. One of the consequences is what? Disallowance under 40A1, 40A1A, 40A3. There are disallowance provisions which we will discuss in PGBP. This is one consequence. Next is penalty under section 271C. Penalty under 271C. Okay, penalties for what? Penalties for short deduction or non-deduction. What is the quantum of penalty? The quantum of penalty will be the TDS. Who is the levying authority? The levying authority is Joint Commissioner. The levying authority is Joint Commissioner. Then, is there any escape route? Yes, if there is reasonable cause, you will escape under 273B. Okay, here one reason issue is there, case law is there, given in the RTP, last RTP, Eurotech Maritime Academy Private Limited, Kerala judgment. Okay, penalty under 271C could be levied even for non-remittance. But if you read the section under section 271C, you will find that the penalty could be levied only for short deduction or non-deduction. Okay, explicitly it doesn't provide for levying penalty on in case of non-remittance. But Kerala High Court has interpreted the provisions to include even the case of non-remittance, and even in such case penalty could be levied under 271C. This is the latest RTP included there. Next is consequence number 3 is interest under 201(1)(a). Interest under 201(1)(a), where there is non-deduction or short deduction, okay, and there is a delay also. Okay, there is a belated short deduction where there is a delay in deduction of tax at source, correct? Tax is not deducted at source in time. In that case, interest will come. Interest nale rate base period. Rate is 1% per month. Base is TDS. Period is, okay, from the due date for deduction to the date of deduction. When tax ought to have been deducted at source to the date on which tax is deducted at source. For this period, tax shall be deducted at source at the rate of 1% per month on the TDS. Where a tax is deducted at source but it is not remitted in time. This is for delay in deduction. This is for delay in remittance of deducted tax. In such case, the base is what? 1.5%, not 1%. Rate is 1.5%, not 1%. Base is what? TDS. Base is TDS. Next is the period is what? It starts from the date of deduction to the date of remittance. So base is the TDS. Rate is not 1%, it is 1.5% per month. And the period for which tax shall be deducted at source is the date of deduction to the date of remittance. Fine. See this example. Here also once again Finance Act 2019 amendment is there. There is proviso to 201(1)(a). What it says? Where a payment is made without TDS. Where payment is made without TDS to a payee who may be a resident, who may be a non-resident. Payment is made without TDS. Okay, payee may be a resident or non-resident. but the payer is not regarded as assessee in default. Why? Because the payee, okay, has filed the return under 139 for the assessment year relevant to the previous year to which the sum received without TDS pertains, and while computing the returned income, he has included the sum received without TDS. Number 3, he has paid the tax on the returned income by way of advance tax or self-assessment tax. Number 4, the payer has obtained a certificate from the auditor in form number 26A to this effect. Then the payer cannot be regarded as assessee in default. In such case, interest under 201 1A will start for the payer. The interest will come under 201 1A, but it will start from what date? From the date of deduction. It will go up to what date? It goes up to the date of filing of return by the payee. It starts on the date of deduction. It goes up to the date of filing of return by the payee. So this is the period for which we shall compute interest. Next is 201 subsection 2. Tax was deducted at source. But the deducted tax was not remitted to the credit of government. It was not remitted to the credit of government. Then such TDS and interest shall be charged upon all assets of the deductor. It's charged upon all assets of the deductor. Fine. Then 276B, you deduct tax at source, but you have not remitted the deducted tax to the credit of government. Then you can be punished with rigorous imprisonment and fine. Rigorous imprisonment, minimum 3 months, maximum 7 years. These are the two consequences only for non-remittance. Next is 205, bar on direct recovery from the deductee, where tax has been deducted by the deductor. To visualize, see this illustration. Mr. M, an individual, had let out his building on a monthly rent of 50,000. On a monthly rent of what? 50,000. The tenant deducted tax under 194I. Deducted tax under which section? 194I. From the rent paid to M. But did not remit such tax to the credit of central government. Correct? And Mr. M filed his return for the assessment year 2021, including the rental income. He paid the balance tax on his total income after taking credit for TDS. Then, in that case, AO cannot say, hey, how can you take credit for TDS? You need to pay that amount, because even though from your income tax was deducted at source by the tenant, he has not remitted to the credit of government. You pay the tax like this. You cannot trouble the deductee. You should only catch the deductor. If he has deducted tax at source, catch the deductor. From him you should recover. You cannot recover it from the deductee. AO cannot call upon M to pay the tax to the extent of tax deducted at source. There is bar on direct demand on the assessee. Where tax is deductible at source under chapter 17B, assessee shall not be called upon to pay tax himself to the extent to which tax has been deducted from that income. You need to catch only the deductor and recover, and not the deductee. Though we will not give credit until we recover, but still we cannot catch the deductee and recover. Sorry. Now next is, okay, the last aspect, okay, here in our discussion is this CVDT circular 11/2017. 11/2017. Please be careful, listen. With that, this TDS chapter will get over. Then we will enter into TCS. Section 119, subsection 2, class A. Section 119, Subsection 2, Class A empowers the CBDT to relax a list of provisions, of Income Tax Act, which inter alia includes 201 1A interest. Okay, so provisions of 201 1A could be relaxed by the CBDT. So in order to avoid stringency of law, CBDT has powers to relax a list of provisions of Income Tax Act which inter alia includes 201 1A. In exercise of this power, CBDT has come out with a circular. 11 bar 2017. Okay, authorizing the CCIT, Chief Commissioner, or DGIT, Director General of Income Tax, to waive or reduce interest under 201 1A. Okay, under which circumstances, specified circumstances subject to the conditions imposed. So CBDT, in exercise of its power, has come out with a circular 11 bar 2017 authorizing the CCIT or DGIT to waive or reduce interest under 201 1A under specified circumstances subject to the conditions specified. But the prerequisite for waiving or reducing 201 1A interest is tax deducted, so should have been remitted promptly. Interest under 234E should have been paid promptly. Sorry, what are all the circumstances in which 201 1A interest could be waived? 201 1A interest could be waived. See this. Listen. In the premises of the deductor, the business premises of the deductor, search operations are conducted by the Income Tax Department. Under 132, search operations are conducted. Income Tax Department conducts search under 132 in the business premises of the deductor. All records are seized by the department. As a result, the deductor could not deduct tax at source. There is a delay in deduction. Then 201 1A interest could be waived or reduced. Fine. Circumstance number 2. See this. Mr. X is making a payment to Mr. Y. Mr. X is making a payment to whom? To Mr. Y. On that, Mr. X feels that there is no TDS obligation. Why? Because the sum is not taxable. How Mr. X knows that this is not taxable? At that time, there was decision from the jurisdictional high court or decision from Supreme Court that the payment made to Y is not taxable. Therefore, there is no TDS obligation. So, therefore, he did not deduct tax at source. Subsequently, the jurisdictional high court decision was overruled by the Supreme Court, or the jurisdictional high court decision was overruled by larger bench decision of the jurisdictional high court. Or the decision of the Supreme Court was overruled by larger bench decision, or there is a retrospective amendment, making the amount taxable. So as a result, because of these changes, subsequent changes, the sum which was earlier understood as not taxable becomes taxable. So earlier Mr. X was not having TDS obligation. Now because of the sum becoming taxable, he has TDS obligation. But he has not discharged it. He has made payment without TDS obligation, without deducting tax at source. Correct? So 201 1A interest may come. but that interest could be waived or reduced. That interest could be waived or reduced. Now, circumstance number 3. What is that? Okay. To visualize this, I'll give you one example. See this. Between India and country X, there is double tax avoidance agreement. Between India and country X, there is what? Double tax avoidance agreement. Sorry, keep aside. R Limited is an Indian company. R Limited is an Indian company. It is making a payment to X Incorporation belonging to country X. It is making a payment to whom? X Incorporation, which is incorporated in which country? Country X, with which India is having DTAA. This payment is taxable under the Income Tax Act, but this payment is not taxable as per the DTAA. As per the DTAA, it is not taxable. Thinking this way, okay, the sum was paid to X Incorporation without deducting tax at source. Without deducting tax at source, correct? Sorry. Subsequently, for the relevant assessment year, this X Incorporation, X Limited illa, X Incorporation, the foreign company, files nil return. Files what? Nil return. The assessing officer took the case for scrutiny under 143(2). 143(3) proceedings were initiated. In the course of 143(3) proceedings, the assessing officer has took a stand that this sum is taxable even as per the DTAA. This sum is taxable even as per the DTAA. The sum is taxable. And as a result, what happens? The payer R Limited should have deducted tax at source on this. Has not deducted tax at source. So R Limited, okay, is regarded as assessee in default under 201(1). Interest under 201(1)(a) was levied. Collection and recovery proceedings were initiated. Against whom? R Limited. But X Incorporation, the foreign company, has challenged this 143(3) order of the AO before the Commissioner Appeals. To consolidate the discussion, friends, listen. Thinking that the amount is not taxable as per the DTAA, R Limited paid the amount to X Incorporation without deducting tax at source. And X Incorporation filed a nil return. But in the course of scrutiny, assessing officer took a stand that the sum is taxable even as per the DTAA and branded R Limited as assessee in default for not deducting tax at source, okay, levied interest under 201(1)(a) and initiated collection and recovery proceedings against R Limited. In the meanwhile, X Incorporation files an appeal to the Commissioner Appeals challenging the order of assessment. So these are all the facts. Now I was telling you there is DTAA between India and country X. In the DTAA, we have MAP, Mutual Agreement Procedure. What is that? I'll tell you. Rule 44 HOD, you should read together. X Incorporation makes an application to the competent authority in country X. As per the DTA, there is a competent authority in country X. Now, X Incorporation makes an application to the competent authority under DTAA in country X, seeking interference. This is the sum which is not at all taxable, as per the DTAA, but the Income Tax Department of India has taken a stand that the sum is taxable and okay, is proceeding further. Please interfere. X Incorporation can make an application to the competent authority in country X seeking interference. Then the competent authority in country X will thereafter make a reference to the competent authority in India. This is the problem, like this they will make a reference. Okay, now the competent authority under DTA in country X and competent authority As per DTAA, in India, they will sit together, they will resolve the dispute mutually. Okay, what sort of interpretation should be placed on, okay, the relevant article of DTAA? Okay, like this, they will resolve mutual agreement procedure. So, competent authority in country X and competent authority in India, they come together, they resolve the dispute mutually. Suppose the decision that is arrived at, okay, as per MAP, mutual agreement procedure is the sum supra is taxable. The sum supra is taxable. That is the interpretation they have placed in, okay, on DTAA. Correct? The sum is taxable. Now what happens? The stand of the assessing officer is vindicated. He is now correct. Correct? So the competent authority in India has to communicate this decision to the AO. Then AO, okay, will freely levy interest under 201 1A. Why? You should have deducted tax. You have not deducted tax. Like this, he will punish. Now, if X incorporation withdraws appeal, now R Limited can approach, okay, the CCIT or DGIT. R Limited, the Indian company in this scenario, can approach the CCIT or DGIT, make application, make what? Application, seeking waiver or reduction, under 201 1A. Got it? So this is one scenario where the waiver is possible. Say the order of the CCIT or DGIT, should be a speaking order. Reasons to be stated as to why the waiver or reduction is being made. Okay, now for rejecting the application or for providing relief, what is the reason? It should be clearly stated in the order. If the assessee is aggrieved with the CCIT's order or DGIT's order, he can file an appeal to the CBDT. It could be challenged before CBDT. But the decision of CBDT is final. Decision of CBDT is final. It is not further appealable. With this, we are through with this CBDT circular. The next area of discussion is limitation of deduction in respect of interest in certain cases. Section 94B. See, in the capital structure, there are two elements. In the capital structure of any entity, there are two elements. Element 1 is equity, element 2 is debt. See, debt is more tax efficient than equity. Why do we say debt is more tax efficient? Why? Because the person who provides us debt funds, to them we pay interest. To the fund providers, interest is being paid. This interest is deductible in arriving at taxable profits. This is deductible in arriving at taxable profits. It is deductible in arriving at taxable profits, resulting in tax shield. Resulting in tax shield. But however, equity is not tax efficient. Reason being, to the fund providers we pay dividend. Dividend is paid to the fund providers. This dividend is not a charge, it's an appropriation. It's an appropriation. Whereas interest is a charge against profit. That means this dividend is out of taxable profits, out of taxed profits. And this dividend is also liable to DDT. Also liable to DDT. That's the reason why dividend is not tax efficient. That equity is not tax efficient. Only debt is tax efficient. Why do we discuss all these things? Because in a multinational group, there can be an Indian entity. There can be an Indian entity being a constituent. This may be subsidiary of a parent entity, parent foreign entity. Parent foreign entity belonging to the same group. This is also constituent. So, in the same multinational group, there can be an Indian entity which is subsidiary of a parent foreign entity. See, the capital structure of the Indian entity, if you see, this may have equity as well as debt. The fund comes only from the parent entity. The funds are coming only from the parent entity. While they are putting their funds into the Indian entity to create capital structure for the Indian entity, okay, they will ensure that the equity component is less, more they put by way of debt. More they put by way of debt. Less will be the equity, more will be the debt. Okay, the reason is debt is tax efficient. Debt is tax efficient. They put more into the capital structure of the Indian entity by way of debt. It is more tax efficient. Less by way of equity. Okay. Here, on account of putting more debt, there is financial risk, na? This financial risk is irrelevant. Reason being, this Indian entity is not a stranger. This Indian entity is only a constituent of this multinational group. So they have control over the Indian entity. So they are not worried about the financial risk. So they put more into the capital structure of the Indian entity by way of debt. This is called thin capitalization. This is called what? This is called thin capitalization. Thin capitalization. Why do they follow this thin capitalization? This is for cross border shifting of profits intended to achieve cross border shifting of profits. That means the aim is to reduce the tax base in India, to reduce the tax base in India, to reduce the tax base in India. That means this is a situation of BEPS, base erosion profit splitting. Base erosion profit splitting. So in order to prevent the country's tax base a ceiling is to be put on the deduction. A ceiling is to be put on the deduction in respect of interest. In order to prevent the country's tax base, a ceiling is to be put on deduction in respect of interest in arriving at the profits for taxation. Profits for taxation. Accordingly, section 94B is inserted. Therefore, section 94B is inserted. This is the background behind insertion of section 94B, section 94B. So this is introduction to section 94B. Measure to tackle thin capitalization. Measure to tackle thin capitalization. Fine. In this background, let us discuss provisions of section 94B. Provisions of section 94B. Fine. In 94B, what is given? Let me show you. When 94B applies, first of all, let us learn that. Assassi should be an Indian company. First of all, Assassi should be an Indian company, or Assassi should be an Indian PE of a foreign company. See my finger. Assassi should be an Indian company or Indian PE of a foreign company. The assessee issues debt and raises funds. The assessee issues debt and raises funds, that is, it takes loan from a non-resident associated enterprise. And the assessee is paying interest. Or I can even write afresh so that you can follow step by step. Assessee raises debt, funds from its non-resident associated enterprise. And it is paying interest. And this interest is more than a crore. The interest payable to the non-resident associated enterprise is more than a crore. Then, in this interest, we will divide that into two parts. Normal interest excessive interest. We divide this into two. Normal interest, excessive interest. Like this, we divide that into two. This normal interest, we don't have any problem. This is obviously deductible under 36(1)(3). This is deductible. But if it is excessive interest, then that excessive interest is disallowed. It is disallowed under 94B. It is disallowed under 94B. Let us add more points subsequently. In a graded way, let us learn. Assessee raises debt funds from non-resident associated enterprise. The interest is more than 1 crore payable. Normal interest portion is deductible. Excessive interest is disallowed. So, what we are discussing is 94B. How do we quantify this excessive interest? We will discuss, no worry. Listen to me. This excessive interest is quantified this way. The excessive interest is lower of the following two. It is lower of the following two. Number one, total interest paid or payable by the assessee minus 30% of earnings before interest, tax, depreciation and amortization.